The Federal Reserve, in a widely expected decision, raised its benchmark rate by 0.25 percentage point, to a range of 1.25% to 1.5%. The Fed also predicted stronger economic growth over the next 3 years. It forecast 2.5% growth in 2018, well above its previous forecast of 2.1% growth in 2018, published in September. Janet L. Yellen, the Fed chairwoman, said the faster growth forecasts reflected an assessment of the $1.5 trillion tax cut moving through Congress. Officials did not deviate from their 2018 outlook for interest rates or inflation and continued to signal 3 interest rate increases next year. The Fed continues to raise interest rates because officials are confident that the economy is in good health. This is the 3rd time the Fed has raised its benchmark rate this year. In a statement published after a 2-day meeting of its Federal Open Market Committee, the Fed said recent economic data showed that the labor market has continued to gain strength and that economic activity has been rising at a solid rate. But the Fed remains cautious about the pace of rate increases. In an updated economic forecast, Fed officials predicted that inflation would stay below the Fed's 2% target next year, and then stay at 2% in 2019 and 2020. With inflation expected to remain under control, Fed officials continued to predict a measured march toward higher rates. They forecast the Fed's benchmark rate would rise to 3.1% by the end of 2020, up slightly from the last forecast of 2.9%. Concern about the low level of inflation led 2 officials to vote against the rate increase: Charles L. Evans, president of the Federal Reserve Bank of Chicago, and Neel Kashkari, president of the Federal Reserve Bank of Minneapolis. In recent public remarks, both have said the Fed should wait to increase rates until there is clearer evidence that higher interest rates are needed to prevent inflation from rising too quickly. With Wednesday's rate increase a foregone conclusion, investors had put the chances at 100%, attention focused on what the Fed had to say about next year, particularly about the effect of the prospective tax cut. We continue to think that a gradual path of rate increases remains appropriate even with almost all participants factoring in their assessment of the tax policy, Ms. Yellen said. Fed officials predicted that the tax cuts would deliver relatively modest economic benefits, adding a few tenths of a percentage point to the pace of growth. Importantly, they also indicated that the economy had room to grow a little more quickly, and that they did not expect the stimulus to increase the pace of inflation. Ian Sheferdso, chief economist, Pantheon Macroeconomics. The key result of the growth revision to next year is that unemployment is now expected to end the year at 3.9%, down from the previous 4.1%. This looks hopelessly unrealistic to us. The Fed appears to be assuming either a surge in productivity growth or a leap in participation. They might happen, but we think a more likely end-2018 unemployment rate is 3.5% or less. Had the Fed forecast that, they would have had to put in another rate hike in the dot plot for next year. The inflation forecasts flat or 2018 to 20 are all unchanged from September, despite the tighter labor market.